Thanks very much, John. As John has said, I'm the Chief Economist in Investec, so maybe just to start off by introducing the Investec businesses in Ireland. I think a number of the themes that previous speakers have touched on are areas that certainly we can help businesses address some of those challenges that Brexit has thrown up. So just to begin by maybe talking about our presence, we have 9,000 colleagues globally, of whom 237 work across our two offices in Ireland, in Dublin and also in Munster. Our business was founded in 1974 in Johannesburg, and for 3 of the past 4 decades we have had a presence in Ireland. We have acquired businesses such as NCB Stockbrokers and Gandon Capital Markets as well. So in terms of our asset base, we manage 124 billion sterling of assets, including some pretty substantial investments in this economy also. In terms of our main businesses in Ireland that face the food industry, I think a number of those businesses are certainly very relevant to the challenges that have been identified by the other speakers. Our corporate finance business is involved heavily in terms of helping to raise finance for companies and also in terms of M&A advisory. So in terms of some of the comments from the last speaker, Paul, there about the access to finance for companies, I think corporate finance colleagues here can certainly help in that area. Also in terms of what the issues that have been thrown up directly in terms of the market reaction to Brexit, the foreign exchange rate volatility, interest rate uncertainty, commodity prices have moved very violently as well, and our treasury business in Ireland is very involved in advising SMEs, particularly in the food and beverage sector, on that. So if any companies here have concerns about those issues in the wake of Brexit, please come and talk to us about that. And then finally, our wealth and investment business provides a lot of advice to companies and their executives in terms of things like financial planning, retirement planning, and so on. So just in terms of what Brexit means for Ireland, as John says, I work on the economic side in Investec, so my stock and trade is very much to look at the hard data. But given that Brexit happened so recently, we haven't had a lot of data that's come out yet. What we have had has been an awful lot of surveys, and some of those surveys are shown on the chart there behind me, and when you look at them, they would give you a lot of cause for discomfort. So in the top left there, you see the Business Confidence Index from the Confederation of British Industry, and that collapsed back to levels that were last seen in the wake of Lehman Brothers in 2008-2009, just post-Brexit. Below that, you've got the GfK Consumer Confidence Index, which fell to levels that had last been seen in 2013 at the peak of the Eurozone crisis. So in terms of these, I think some of that sentiment, though, was a bit overdone. During the Brexit campaign, there was what people called Project Fear, which was that the sort of view that if people of Britain vote for Brexit, then the sky is going to fall in. So certainly in the back of that, you saw an awful lot of surveys where people were clearly very scared about what happens next. But we think the outcome for the UK is actually going to be a bit more benign than what those surveys suggest. Indeed, in terms of GDP forecasts, what this shows here, it's the black line showing the historic trend in UK economic growth, and then beyond that you've got Investec's forecasts. We see the UK economy growing by 0.8% next year. Now that's a big downgrade to what we had before. We were expecting the UK economy to grow by about 2.5%, but at the same time, while we do expect it to grow at a much slower pace, it's still expanding. So I think the last slide was kind of, people were expecting an apocalyptic scenario, and what we've seen on the back of that is that UK should continue to grow, but maybe not as fast as before. But despite the fact that the economic outlook is probably a bit more benign than what people had expected, I think we're in for a very extended period of volatility. And that's very much reflected by some of the market moves that we've seen. In the wake of Brexit, you had dramatic moves in currencies in particular, as many businesses here don't know only too well. You saw the sterling fell to a 31-year low against the US dollar and to a 3-year low against the single currency. So that's representing significant headwinds for margins across the food and beverage sector here in Ireland. You also saw some very significant moves in terms of asset valuations, with double-digit price declines seen in stock markets both here in Ireland and also in the UK, but most of those losses have been recovered since then. But what's been going on is that there's what they call in markets a flight to safety, where people have been selling the riskier assets like shares and moving into things like the bond market. So you've seen a significant compression in borrowing costs for sovereigns. The Irish 10-year bond yield fell to just 0.3%. 3%. And I think just a good illustration of some of the nervousness that has followed Brexit and what may happen on the back of it is that in Switzerland, and I think this is my favorite measure of the sort of risks in the sentiment in the market, is that the 50-year bond yield for Switzerland is just 0.01%. So people in Zurich, Geneva, Lausanne are buying a bond that will mature in 50 years' time and pay them a return of only 0.01% a year over that period. So I think there's an awful lot of nervousness, and the problem with this nervousness is that it's not going to go away anytime soon. Because what the UK has to do, of course, if they accept the verdict of their people, is that they have to negotiate their divorce from the European Union. Now, if you look up Article 50, which is the mechanism through which the UK can leave the European Union, you'll see that it's very short on detail. If you click on the page on the website, you'll see that Article 50 won't even take up half of your computer screen, because they obviously drafted it on the expectation that no country would ever be crazy enough to activate this. It's about 10 lines saying, if you're going to leave Europe, you've got 2 years to negotiate, and you can extend it if everybody agrees to it, but there's risks with that. Now, what's the past history? What's the precedent for whether this is any way realistic? And when you look at history, you can see it is totally unrealistic that the UK could leave Europe within 2 years of Article 50. In the 1980s, Greenland left Europe. It took them 3 years to negotiate their departure. Greenland is a country of only 55,000 people. The UK is obviously 1,000 times bigger than that, and significantly, the only thing Greenland was negotiating about was fishing rights. I think the UK has a bit more to talk about, having been a member of Europe since 1973. It's also interesting to think about Switzerland, which recently signed a bilateral trade deal with the European Union. It took them 6 years to negotiate that agreement. It doesn't even give them full market access, as I'll talk about in a second. But what's significant is Switzerland is a tenth the size of of the UK economy, and also they're not even a member of the EU, so they would have had less to talk about. So realistically, Brexit could take more than 10 years to negotiate, that is if they even leave Europe at all. It's a bit reminiscent of the old Hotel California song, you can check in, but you can never leave. And I think the other thing that's worth bearing in mind is that the UK has not had to negotiate any trade deals since 1973, when they joined the European Economic Community, as it then was. And as you know, anybody who was a senior civil servant in 1973 has long since retired. So the UK does not have the manpower to negotiate trade deals, not just with Europe, but also with 53 other countries where their trade deal will end when they leave the European Union. And it's also significant that the World Trade Organization has said that the UK will have to renegotiate its membership of the WTO, given how things have changed. And it's a bit fanciful, as the likes of David Davis are suggesting, that they can conduct parallel negotiations with all of these countries, because no country is going to cut a deal with the UK until they know where does the UK stand with the European Union. So Brexit, as I say, will take at least 10 years to negotiate, and the risks that they may do a U-turn on this should not be discounted. So what models might they go for? There's been a lot of talk about the Swiss model, but the thing with the Swiss deal, they may have access to the goods market, but they don't have access to financial services. So if you go over to London, if you fly over there tomorrow, you jump on the tube and you get out of Canary Wharf, one of the first skyscrapers that you'll see has got Credit Suisse written on the side of it. And that's because they can't sell financial services products from Switzerland into the EU, so they've had to move a lot of capacity into the European Union to sell there. Given that the City of London contributes about 15% of UK income tax, I seriously doubt that the UK government would agree to a deal where they will lose all of those high-paid jobs. They will want to keep them there so they don't go to Dublin, Frankfurt and Paris. Now, the next package is the Norwegian model. On paper, it sounds okay. You've got more or less free access, with some exceptions to the goods market and the services market. But the problem with the Norwegian model is that they have to pay their way in. Norway is the 12th biggest contributor to the European Union budget, even though it isn't even a member. So that's something that's significant. They have to buy their way in. And the other two commonalities across the Swiss and the Norwegian models is that they've had to agree to free movement of people, and also they have to accept most European Union laws without having any ability to draft those laws. So when you think what was being promised by the Brexiteers during the campaign, they said we're going to free up money for the NHS. Well, that's hardly going to happen if you're like Norway that has to buy your way into the market. They said we're going to put a stop to immigration. That's not going to happen if you're going to have free movement of people. And they also said we're going to take control. Well, you're not going to take control if you're going to end up having to take European laws that you're no longer able to help draft. So for these reasons, it's very difficult to see how they can work out some sort of acceptable package for the UK in any reasonable period of time. And while the alternative, of course, is to go to the World Trade Organization rules, when you look at the actual tariffs, it's penal for the UK. We're talking double-digit tariffs on things like car exports, and you know the voters of Sunderland and Dagenham will not be happy with that if English cars become so much more expensive. So what does it mean for ourselves here in Ireland? Let's bring it back to home. Now, as Paul outlined, the currency moves are the main headwind for the Irish economy, for many Indigenous firms here. Now, what I've done on the chart on the left-hand side there is I've looked at the old exchange rate between the old Irish punt and the pound sterling. Now, I've kept the Irish punt at the conversion rate that we went into the single currency at. And when you look at that chart on the left, you'll see that after when we got our free float against sterling in 1979, the biggest peak in the history at that point was in 1992 when England was kicked out of the exchange rate mechanism. And what happened then was that the Irish punt soared above parity against the pound sterling. That was an extremely difficult and challenging period for many firms in Ireland. And when you follow the chart on the left along, you can see that the notional Irish punt to UK pound rate is up at the levels that were seen at the time of Black Wednesday in 1992. But what's very significant is the chart on the right-hand side, which is to look at the share of our exports that have gone to the United Kingdom, our goods exports. In January 1973, when we joined the EEC, some 59% of Irish goods exports went over the border into the north or across the Irish Sea to Britain. That share has fallen to just 14%. So we've diversified very heavily away. So the overall economy is more insulated than we were at the time that we joined the European Economic Community, where we had very much an umbilical relationship with our next door neighbours. What does it mean for the food sector? As has been discussed previously, about 2/5 of our food exports and 1/5 of all of our beverage exports go to the UK. So this is the sector that is going to be one of the most adversely affected by Brexit, specifically the impact of foreign exchange volatility. There's also concerns, as David and Paul have also touched on, around things like supply chains, food safety, what if Britain decides to go for different regulations than the European Union and so on. So these are challenges that the sector is going to have to very carefully manage. Teagasc have said that the impact of Brexit on our agri-food exports could be between 150 million a year or 800 million a year, so up to 8% adverse hit on our exports. So this is something where new strategies will be needed, particularly in the areas of the food and drink sector that are excessively exposed to the UK. Things like cereals, fruit and vegetable exports, live meat exports as well that are overrepresented in terms of exports to the UK. Paul has touched on a number of proactive things that government and other policymakers can do to mitigate against this, and I would echo many of his recommendations. So just to wrap up, in terms of the short-term consequences for the broader Irish economy, what do we see happening from Brexit, from the vote? In the short term, we're looking at a very significant adverse impact for our exports to the UK, which are about 1/6 of total exports. So 5/6 of Irish exports don't go to the UK, but the 6 that do are obviously under a lot of pressure. You've also got issues in terms of competition from cheap imports from the UK. Anything that was being brought in before is an awful lot less expensive than it previously was. Now, the silver lining of that is that companies that are sourcing imported components, and Paul mentioned this, they are also cutting their costs on that side. So there is some silver lining for some firms, but obviously it's pressures for many more. The Irish government, the Irish economy could benefit from winning a higher share of foreign direct investment. So there are some other silver linings as well, and this is an opportunity that should be pursued. Over the past 5 years, we've won about 8.5% of foreign direct investment into Europe. The UK has won 17% over the same period. So I'd like to see us winning additional share at the expense of our friends across the pond. But as I say, because only a sixth of our exports go to the UK, the overall impact on Irish growth will be limited by that. So every 1 percentage point move in UK GDP moves Irish GDP by about 0.2%. So while we did take back our growth forecast for Ireland on the back of Brexit, we still think that the Irish economy will grow by 4.8% this year and by 3.5% next year. These forecasts, incidentally, do not assume any Apple-related windfalls. They assume real underlying, tangible growth in the economy, and these are sort of growth levels that many countries in the world would absolutely kill for. In terms of the long-term consequences, the simple answer is nobody knows. There's lots of tinfoil hat-wearing boffins at leading research institutes are telling us, oh, it could cost 1% of GDP, 3% of GDP. Nobody actually knows, because we don't know what the trading agreement between the UK and the European Union, including ourselves, is going to be. So in terms of the outlook, where we would focus on, and this was touched on in the last presentation as well, is that we think that the weakness in sterling, this isn't a cyclical move. This isn't something related to the business cycle. This is a structural or permanent weakening in sterling. And the reason for that is that the UK had built up a reputation for being a very safe place to invest and do business. And I think on the back of this has injected significant uncertainty, and I don't need to tell anybody in this room that uncertainty is the enemy of business and investment. So in terms of this weak sterling, this will be with us for a long time. We are not going to see 70p to the euro anytime soon, which leads to an awful lot of thinking that will be required by a lot of Irish companies in this area and about strategies to address this, and also in terms of things like supply chains. If there is a hard Brexit, companies will need to protect themselves in that eventuality. Now, as I touched on already, it is possible that we are going to win increased foreign direct investment because we have become relatively more attractive we've become relatively more attractive in the wake of Brexit as a location for FDI. And what I would say on that is that you just need to look out the window and you can see all the cranes over Dublin that are building offices. There's plenty of office space under construction, 8 million square feet, to accommodate all the jobs that could arise if we play our cards right on Brexit. But where we risk shooting ourselves in the foot is if we do not address the problems in our residential property market. As you know, there are chronic shortages of accommodation, and we cannot credibly say to people, come to Ireland, work in Ireland, invest in Ireland, if you can't find a place to live in Ireland. So the final note that I'll touch on is that policymakers need to reorient their thinking away from giving people grants to buy houses, as the newspapers are suggesting today, towards changing the policy to make it a lot easier to build houses. Because if we have the capacity to welcome all these jobs, we could do very well indeed out of aspects of Brexit. But clearly, as I say, there will be sectors that will face pressures in the intervening period. So with that, I thank you for your attention, and I'll pass back to John. Thank you.